Good evening friends. So we are discussing the chapter portfolio management. In the previous video we revised till capital market line. We started with basics of portfolio management, then we did Markowitz's portfolio theory, capital allocation line and capital market line. Now we will discuss very important concept, that is capital asset pricing model. Every attempt in the examination they test somewhere around 8 to 10 marks. Okay, either they directly ask questions from this area, or they will include the security valuation, equity valuation portion, and they may ask questions from combined area. Okay, so what are the things to be discussed here? One is security market line. We will start with security market line. Security market line is nothing but graphical representation of the CAPM model, and then SML versus CML, the capital market line which we discussed in the previous segment, that we will consider, and then we will find out the differences between capital market line and CAPM. Then identification of under and overpricing of capital assets. Okay, using KE and expected return, how to find under or overvaluation using the see, in the security valuation chapter we found out the value of the security, then we compare with the compare the value with price of the security and then made decision. Are you understanding? Here what we are going to do is that we compare the expected return and required rate of return, and then we will find out valuation of the security based on this. Okay, next calculation of beta. Okay, everything about beta we are going to learn. So beta, there are 6 formulas for computing beta. 3 formulas we will learn in this segment. Okay, this segment we will learn which are correlation based formulas. Then in the regression analysis, in the sharp single index model, 3 more formulas will come into picture. Next, portfolio beta, levered, unlevered beta and proxy beta, everything we are going to discuss. See, we will start with security market line. See, what is the CAPM all about? What it tries to do now? Very simple. In the entire chapter, only 2 things are relevant. One is how to measure the risk, how to quantify the risk of a security or portfolio. Then for a given level of risk, how much return I should require, how much return I should expect or ask for the security, ask from the security. Now, the CAPM came after the sharp single index model. Okay, the sharp was the brain behind all these things. He came up with a theory. What his research is predominantly now, he tries to segregate the risk into total risk into systematic and unsystematic. Are you all understanding the basic? Very simple. He segregates the total risk into systematic, unsystematic, and he tries to quantify the systematic and unsystematic. Are you all understanding? He tries to segregate first, then he tries to quantify the how much of this risk is systematic. What is the way to find out the systematic risk with respect to total risk, then unsystematic risk out of the total risk. Are you listening? This is his contribution. Okay, CAPM, thereafter what happened? Risk you quantified. The risk which you quantified, what he says is that the required rate of return, the KE, that is what the discounting rate which you are finding out. The required rate of return, okay, there R minus RF you are asking for premium. That premium you should ask only with respect to systematic risk. This is the research. Are you understanding? Which means in the previous model and all we saw that the R minus RF was attributable to the entire risk, portfolio risk. Here what he says, even though the total risk of a security, okay, can be segregated into systematic and unsystematic, but premium which you are asking now, RM minus RF, that market risk premium, that only can be asked with regards to the systematic risk and not unsystematic risk. Are you understanding? Now we will see what is systematic, unsystematic. Okay, see, very simple. What do you mean by systematic risk, unsystematic risk? See, systematic risk, the risk which is present in the system itself. Now by system, what I mean by system, very simple, the macroeconomic factors, very simple. Yeah. See, market is also one of the macroeconomic factors. See, for example, geopolitical issue, okay, then interest rate changes, exchange rate fluctuations, okay, currency risk is there, correct? Then we have GDP data, okay, labor data, so many things are available. Okay, these things are called as systematic risk. Systematic risk which is present in the system itself, and okay, you can never just diversify the security and reduce the systematic risk. Very simple. In the previous discussions and all, in the Markowitz's portfolio theory, I told that diversification will reduce risk. Agreed? But this model says diversification will reduce risk, but can only reduce the unsystematic risk. Systematic risk can never be reduced by diversification. Are you all understanding? Anyway, it will be there. Very simple. I will give you a classic example. In the March 2020, COVID came now. Suddenly lockdown happened. Correct? They announced a lockdown. Now what happened? Entire business, everything shut down, nationwide lockdown. Now because of this, what happened? Okay, people don't know when the business will start getting going, right? So what happened? Okay, entire business share price fell down. Correct? Now You tell me you are an investor, ordinary investor, you bought Reliance Limited, then you bought 10 other companies thinking diversification will reduce risk, but COVID came, entire portfolio crashed. Are you all understanding? Not only the market, everything crashed. So all the prices of all these securities fell down. So which means it doesn't make any sense. Okay, diversification will reduce risk, but the risk which is arising from the system itself, this risk will not be reduced simply by diversification. Are you all understanding? So it arises due to macroeconomic factors like inflation, exchange rate fluctuation, interest rate changes, GDP, etc. Even when we diversify fully, this risk this risk cannot be eliminated because it exists in the system itself. The risk is also called as non-diversifiable risk. Are you all understanding what is systematic risk? Now, unsystematic risk, what do you mean by unsystematic risk? Unsystematic risk is nothing but company specific risk. Company specific risk, which means, see for example, Ratan Tata was there, great entrepreneur, great leader, right? He passed away, right? Assume it never had any impact on Tata shares, but assume promoter, okay, is no more, right? Who is the key person of the, he is the key driver of the business. Are you listening what I'm trying to say? These are all company specific factors. For example, I produce some cars, then EV came into picture. The product which I am selling became obsolete. Now, are you all understanding? Which means there are so many. For example, okay, we have the insider trading. See, the company's promoters violated insider trading norms, which was given by SEBI. What happened? It penalized the promoters. Promoters were arrested. The stock price fell. Are you listening what I'm trying to say? So share price maybe falling due to various other reasons, due to company specific reasons. I am telling this as company specific reason. It may happen. These are unsystematic risk, which is not due to the system, which is company specific. Are you all understanding? This risk can be eliminated through diversification. Are you all listening? See here, diagram showing types of risk. The left side, okay, the y-axis is there. This is the total risk. Okay, see here, I've given total risk, number of security. What is happening? You see, you keep on adding the right side, okay, you keep on adding security, the risk will keep on falling. Are you all listening? But at some point, okay, it will be stagnant and it will never be reduced. This portion, I call it as systematic risk, which means systematic risk will never be reduced fully, or to put it simply, the risk starts from here, it falls down, but it never touches down the x-axis. If it touches down the x-axis, the total risk will become zero. It will never touch the x-axis. Okay, at some point it will stop, which means I can call this system as unsystematic risk. Yes, the unsystematic risk only can be reduced, diversified and reduced, and never the systematic risk. This is just a representation. Now, the next point, this also I explained, the premium which you require, that you should ask only for the systematic risk and not for the unsystematic risk. Are you listening what I'm trying to say? The premium which you are asking only should be asked for systematic risk, which is present in the risk itself. Unsystematic risk and all, you should not ask a premium. Okay, for your promoter is doing a mistake, you should not ask a premium in the market for this purpose. Are you listening? So only the systematic risk which is inherent in the system, we cannot do anything. For that you can ask premium, not for the unsystematic risk. The required rate of return from a security depends on risk taken. The SML equation helps to find out, okay, the required return from a security. The equation is as follow, which means the KE plus RF plus KE is equal to RF plus beta into RM minus RF. This is the formula. Here the RM minus RF, see, I'll just break it down for you. See, what is the formula as per this model CAPM SML equation? See here, KE, which is required rate of return, is nothing but RF, okay, plus beta times the RM minus RF. Agreed? Here you need to understand this RM minus RF term is called as market risk premium. You already know, nothing surprising, correct? Market risk premium, which means, see, what is the form? I explained in capital market line itself. RF is the return, more risk, more return, less risk, less return, zero risk, zero returns order, some return, that is risk free rate of return. Agreed? So which means RF is the return which I earn without taking any risk, plus, okay, if I invest in market, I will have to ask for some premium, because more risk you have to compensate with more return. Now the point is, how much risk I need to take? The beta times the RM minus RF. In capital market line, here itself I will distinguish what is the difference between the capital market line and capital asset pricing model, or SML. See what happens here. In the capital market line, we had RF plus, this is same, RF was same, RM minus RF also same. So what is the difference now? The beta is there now, there is only difference. In the CML equation, we had RF, this I am not considering here, it is there to be understood. Okay, sigma P by sigma M, you can go through and refer that, you will understand. We had RM minus RF, agreed? This is the capital market line. Sigma P or sigma S also, where there is only one security inside your portfolio, then it is single security portfolio, single security only you have invested. Now it will become sigma S security. Okay, then if you have invested in portfolio of stocks, this will become, numerator will become portfolio, sigma P. Simple, portfolio risk divided by market risk. What is the understanding now? See, if you invest, if you invest 100% of your money in market, the entire market risk, total market risk will be your risk, portfolio risk. Are you listening? If you invest, you are combining RF plus RM. I told you now, these two securities you are combining, capital market line, agreed, capital allocation line or extension. Now, if you are in, it is a mixture of these two securities, risk-free security and RM. Okay, RF will never have any correlation, the risk will become zero. Agreed. The weight of the portfolio or the risk of the portfolio is simply, okay, risk of the market into a return of the market. Are you all understanding? This I already explained. Now here, okay, I am not going into derivation of the formula. The point I am making is the entire portfolio risk, for the entire portfolio risk, you will ask a premium. Are you all understanding? The change is that, the only change difference is that the numerator you had in sigma P a portfolio risk. For the entire portfolio risk, you considered RM minus RF. Are you listening? The market risk premium, okay, you were asking for the entire portfolio, which is not correct. As per SML, what they say, na, okay, you should ask a premium, this is sigma P by sigma M, correct, into correlation of S and M, or sigma S or sigma P, that is understood. Here, correlation of P and M, portfolio or market. Are you listening what I am trying to say? Market itself is a portfolio. If you make individual securities inside the, okay, I told you now, the securities will be replaced by market. Are you listening? So, sigma P by sigma M or sigma S by sigma M into correlation of S and M. This is a formula for beta. This is nothing but one of the formula for beta, which I am going to discuss in detail. Just now, just understand what they say, what the CAPM states. The market risk premium RM minus RF should be multiplied with not simply portfolio risk by sigma M into correlation of SM and M also you should consider. This is nothing but beta, and beta times the RM minus RF. Are you all listening what I am trying to say? Which means for system, this beta is a representation of systematic risk. What do you mean by systematic risk? That portion of the risk, portfolio risk, which is correlated R into S and M is what is the formula? This is correlation. That portion of the portfolio risk which is correlated to the market, okay, for that only you should ask for RM minus RF market risk premium. Are you listening? Which means beta is a representation of systematic risk, not the total risk, and so only for systematic risk you should ask a premium. This is the crux of the discussion. Okay, the difference between CML and SML. Are you listening? Okay, see, now you will understand the notes, everything you will understand. The required return from a security depends on the risk taken. The SML equation is this. What is beta? Now, an important discussion. You told 6 formulas are there for beta. All these things you told. But what is beta? First you need to understand. Beta is a statistical measure. Okay. What does it measure? Really? See, what is the change in return of the security with regards to change in market price? For example, if the index, okay, wherever I call index, what do you mean by index? Simply Nifty, Sensex, Nifty. Okay, I already explained. So Nifty, market, Sensex, Nifty, index, everything interchangeably I may use. Same thing. Okay, see, now here what happens? Suppose, assume, is the market price. Okay, this is market Nifty graph. Okay, this is the Nifty, correct? The graph will look like, have you all seen the stock prices? Nifty. Okay, it will be like this around, correct? Now, see what happens. Say this year, this is the starting point, this is the ending point. Okay, assume. Okay, 1% Nifty is down by 1%. Now, this is the return, it gave negative return. Nifty was down by 10%. Assume 1% will be so cheap, 10% assume. Now, stock is falling by 20%. The stock is falling by 20%. What is the change in return of the security? This is the Nifty graph. The stock graph, what happens? This like this, and the stock at the same point, it drops here. Okay, this is the chart of the stock. It will be up and down, up and down. Here the stock, which means Nifty fell 10%, the stock fell 20%. Are you listening what I am trying to say? Which means what beta tries to measure for 1% change in Nifty's return, what is the impact of it in share price? Okay, securities return. For this we already learned in Bond valuation chapter, we learned the concept of volatility. What is volatility in the bond value? What is volatility? Change in bond price with respect to change in bond yield, YTM. What is the formula? Okay, very simple. Change in price of the bond divided by change in YTM. This we use to compute now volatility. Are you all understanding? Formula duration divided by 1 plus YTM, all these things, volatility, approximate measure, convexity, everything we solved. Remember, same volatility we learned in options, we learned something called as, what is that? Delta. Delta, you remember? Okay, change in option price with regards to change in, underlying asset price. We learned the delta in option and volatility in bond, is something similar. Here also we have beta. We have beta in equity. Are you understanding? It's a sensitivity of stock price with regards to the index. Are you listening what I'm trying to say? Okay, next. See, beta is a statistical measure that relates security risk to market risk. Sir, how is related to security risk and market risk? You told change in security return divided by change in market return. See, what is change? See, market return, mean return x bar. Change in return, it is nothing but variability of return. So variability of security return divided by variability of market return. Are you understanding? Variability only is referred to as risk. See, every year if it gives same return, there is no variation, no risk. The variation is only captured. The variation in return is only the risk. Okay. A beta of 2 times means that when market portfolio return changes by 1%, the security return changes by 2%. Are you all understanding? This is very, very important. If beta, very simple, by 1% change in Nifty, what is the impact in the security? In other words, the security is 2 times riskier than the market portfolio. So beta of the market portfolio is 1. This you should remember. Beta of the market portfolio is 1. Okay. So assume the security beta is 2. This is just like P ratio. It is referred to as in times. 2 times beta. Okay, 2.5. What does it mean? Rupees or dollars? Times. Okay, 2 times. Okay, just like P multiple we call it as like that. You will refer in the market. So it is 2 times risky than the market. Say beta is calculated as follows. One formula, 2 formulas. All the 3 formulas we already learnt. Very simple. Change in security return, change in market return. Just now I explained colloquial meaning of the beta, real meaning of the beta. Now, there is 2 more formula. Change in security, sigma yes, risk of the security divided risk of market into correlation of S&M. Are you all understanding? This is another formula which I explained. Okay, there to differentiate the SML from CML. This I explained. Correct? Which is nothing but sigma S by sigma M. Okay, into correlation of S&M. Are you all understanding? The third formula, which is actually this second formula is actually derived from the third formula. Very simple, yeah. See here, what is the third formula? Covariance of S&M divided by sigma m square. This you need to remember. Here in denominator only had sigma m. Here there is sigma m square. Are you listening? I'll show you very simple here. Okay, see here what happens. The third formula is, it's only extra, same thing now. See, sigma s by sigma m into correlation of S&M. This is the second formula for beta. So I can also rewrite, this is what is nothing but sigma s into correlation of S&M, the whole divided by sigma m will be same, the multiplication, it will be multiplied to numerator. Now, what do you do? Numerator and denominator, you multiply it with sigma m. Are you listening what I am trying to say? So, if you multiply the numerator with sigma m, denominator with sigma m, it should give the same answer. Yes. If you multiply the numerator with sigma m, this is nothing but covariance of S&M. Are you listening? This is nothing but covariance term. I already explained what do you mean by correlation formula. While explaining the correlation formula, it is nothing but covariance of 2 securities. I told you correlation of say A and B. We learned is nothing but covariance of A and B. In the first introduction itself I told you, divided by sigma A into sigma B. Agreed? Now, this only, if this is correlation, rewrite is, what is covariance then? Covariance of A and B is nothing but multiply correlation A and B into sigma A into sigma B. This is what is in the numerator. This is correlation of A and B. When you find correlation of S&M, is nothing but correlation of S&M into sigma S into sigma M. The numerator simply becomes covariance of S&M divided by sigma M into sigma M square. Are you all understanding? The third formula is also derived from the second formula. Both are same, one and same. I am saying from covariance only correlation. Co-movement. Right. Securities in the market can be classified into 3 types. Now, important observation. This also you understood, already know. Aggressive stock, defensive stock and normal stock, which means the stock which is trading at fair price, I call it as normal stock. Aggressive stock, which is riskier than the market portfolio. Very simple, yeah. If your beta is more than 1, which means Nifty changes by 1%, Okay, the security will change by 3%. Assume beta is 3. Nifty changes by 1%. It is changing by 3%, which means 10% Nifty is giving a return. It is giving me a return of 30%. When Nifty falls by 10%, it is falling by 30%. More risk, na? Why more risk? Don't think, okay, when it will increase 3 times. When it will decrease, it will sit idle. No, it will also decrease 3 times. Are you understanding? That is why it is called more risky. Upper side also it is huge bump. Lower side also, okay, it is falling more, na? So which means more variability, more risk, hence riskier than the market portfolio. Market portfolio's risk is beta is 1. When you compare this to 1, if more than 1, risky than market, less than 1, less risky than market, and same risky as the market portfolio. So given the situation, beta is more than 1, more risky, less than 1 and equal to 1. Now CML versus SML, just I will walk through because already I have discussed this. Very simple CML equation, return of the portfolio, KE as per CML is nothing but RF plus sigma P by sigma M into RM minus RF. This is market risk premium, MRP. This is, okay, RF, risk-free rate of return. Both these are common, only changes with regards to the premium which you are asking for. Very simple. RF plus here, KE as per SML is nothing but sigma S by sigma M into correlation of S and M. The second formula, okay, I can substitute. This is only beta. Beta out expansion. This is nothing but expansion of beta. Are you listening? Which means the total portfolio, I should not ask premium, only that portion of the risk which is correlated to the market. Both the equation tries to find the required rate, return of the portfolio KE for a given level of risk. Both the equations require RF for taking risk and required premium of RM and RF for taking risk of market portfolio. Okay, CML requires, there is no issue here, but only this is the difference. CML require premium for the entire portfolio risk, while SML ask a premium for only the portion of the security risk which is correlated to the market risk. In other words, CAPM states that an investor should not ask premium for unsystematic risk, should not ask for unsystematic risk. Beta is a representation of systematic risk, only that is eligible for asking a premium because it can be avoided through diversification. Okay, and premium can only be asked for systematic risk. You can easily go through. Are you listening? First segment of the discussion is over. Now we will move on to the identification of underpricing or overpricing based on expected and required rate of return. Sir, already we learned in the security valuation how to find under or overpricing. Very simple here. Okay, see, I told you this is the market. Okay, this is the price available in the market. Which means for any security, listed security, if you want to compare the prices, you go to the market. See, very simple, you are trying to travel and okay, you are traveling from one place to another. Auto rickshaw, you call an auto rickshaw, he asks you some price, correct? Now what you will do, whether you will give whatever he asks you will give. Okay, he's asking for 1000 rupees and you will give 1000 rupees, where fair price is 300. So what you do, you compare the price which is quoted by the person with your own price, which means your own valuation. You think on your own that okay, this is the price I need to pay, this is a charge at 300 rupees is what I need to pay, but he is asking for 1000 rupees, which means is overvalued. I will not get into the auto rickshaw. You can think like that, correct? So market price, this is market price. As per Warren Buffett, he says value is what you get, price is what you pay. Price is what you pay, value is what you get. Ultimately, okay, what you pay it is the market price which will be quoted. No issue, but you need to compare the market price. So you already know that this is a value, this is the price, correct? You compare this price with your own valuation. Okay, you will apply all these valuation techniques. You find the value of the asset on your own and then compare this value, fair value, with the price of the quoted price of the asset, and then make informed decision whether to buy the security or sell the security, correct? This is okay, identification of under or overpricing based on the valuation, as such the value of the asset. But now there's one more angle to it. What I am trying to say is, see, we have one more thing, the expected return, which I call it as mean return, X bar, and the securities return, the required rate of return, which is KE, Are you listening what I am trying to say? Which means you have required rate of return, you have expected rate of return. Okay, very simple terms. I will give you a classic example. Okay, people find this difficult to understand. I'll give you an example you will easily understand. See, just I told you, assume you are waiting in Chennai airport, you want to get into some auto rickshaw or some cab. Okay, you want to travel to Nungambak, and the cab driver is charging you 1000 rupees thinking you are from North India. Assume you are from Bombay. So they would not know the locality, how much is the distance, how much is the, assume they are thinking you are a new person, they are charging 1000 rupees. But you know that you are a local person and you know what is the fair price for this travel distance, what is the fair price. You already know that it is only 300 rupees. Are you understanding what I am trying to say? That person is asking for 1000 rupees, correct? Now what is the required rate of return? He requires 1000 rupees return, in terms of percentage, that is different. I am just giving you an example. He requires 1000 rupees, right? For this service, he requires how much amount? 1000 rupees. But what is the fair amount or expected from this travel? What is the expectation of the general public? 300 is the expectation. Are you all understanding what I'm trying to say? Which means 1000 is the required return, expected return is 300, which means you tell me this the requirement is satisfied or not, getting satisfied or not satisfied, correct? He requires 1000 rupees, na? Expected is only 300. You tell me undervalued, overvalued? See, required rate of return is high. Okay, security is undervalued or overvalued? Overvalued, which means you will not buy the security. Are you understanding? If a person is only willing to pay you 300, okay, and you require 1000, okay, will you consider this transaction? No, na. So what I'm trying to say is that when required rate of return, which is KE, is greater than mean return, see the expected return, mean return, na? The mean return is what the security is giving. The required rate of return is what you require from the security or you expect from the security. Are you listening what I'm trying to say? Sir, whatever is the security is giving, the mean only I will expect, na? Mean only I will require. Why I require more than mean? You may ask question. Very simple classic example I'll give you. See, here you go to a bank, yeah? You go to a State Bank of India, you ask how much is the interest rate. Okay, 1 year deposit you want to make, you are asking State Bank of India, they are quoting an interest rate of 7% per annum, assume. Okay, now you go to Jagannathan's Bank of India, assume. There is no bank as such. Okay, I am giving you money privately, correct? Now you ask rate of interest. Rate of interest, are you all understanding? Which means whether, okay, I tell, say, I am telling that I will give you 7% return, the same rate which you earn from State Bank of India. I am promising you, I will pay you also equivalent amount. Why you invest in State Bank of India? Are you all understanding what I am trying to say? Are you are not at all known person, you are a new person, how can I trust you? Okay, there is a risk component, na? You may take the money, you may loot it, okay, there is no guarantee. Are you listening what I am trying to say? If I invest in State Bank, it is less risky, na? So my deposit is safe there, which means for any asset, for any investment or asset, okay, the risk factor is also to be considered. For example, Reliance Limited is coming up with a new bond issue. Same way some other company, listed company, but from SME segment, a small company is coming up with a bond issue. Will the rate of return will be same, rate of interest will be same of these bonds? No way possible. Why? See, the Reliance Limited can raise money from a 10% instrument. But in case of other company, it cannot raise money at the same rate. Okay, it has to compensate. Why? Because the investors will undertake a higher risk. They will perceive the instrument to be more risky, which means, okay, after the expected return is what the security will give, but after considering the risk factor of the security, I may even require higher than what the security is giving. Are you all listening? Okay, these are all profound discussion. I don't want to get into these things. In the regular batch, I used to discuss and make you understand, but here, beyond this point, you don't require also for examination, which means in a simple term, you understand that your required rate of return, if it is more than expected rate of return, which means you require more, your requirement is not getting satisfied. Okay, your requirement is the benchmark to assess whether the security is undervalued or overvalued. If your requirement is not getting satisfied, it means the security is overvalued. Here I have put required rate of return is high, but expected return of low. This is what I showed you in an example. The security is overvalued, overpriced, and hence sell the security. Okay, there is no point in investing in the security. Okay. Then anyway, see, sell I have given because if you already have the security, if your requirement is more than what is the security gives, you sell. If you have not bought the security, then never buy the security, which is not at all, fulfilling your requirement. Next, expected return is high, required rate of return is low. I require, after analyzing the security, I require only 10% return. But this security is giving me 20% return based on the past data analysis, mean return, correct? Will I buy the security? Of course, yes, this is underpriced and buy same and perfectly priced, hold the security. Okay, if you are already having hold the security, okay, if you want to buy the security, it depends on you, whether you want to buy the security at fair price or even cheaper price. It all depends on investor's perspective. Now come to the graphical representation of CAPM, very important understanding. See, the under or overvaluation, you can understand in this manner. Very simple, the same CML representation of CML we did in one graph, same thing here also, RF is same, okay, and here only change in the beta, if it is 1, beta is 1, assume the beta is 1, beta 2, beta 3 like this, if you, okay, the beta is more than 1 like this, it will go. Are you understanding? This is risk, this is return, this is risk and this is return, but here risk is measured using beta instead of standard deviation, that's the only change. If assume this is beta 1, if the entire beta 1 entire amount, if you invest 100% of your money in market portfolio, the beta will be 1 of your portfolio and the return will be 9% assume, some return. Okay, it depends on beta given in the question, and this is market return. Assume this is beta 1 means beta, yeah, assume the beta is equal to 1. This is beta is equal to 1. Na? This is market. Na? Market, what market is giving? RM. If you invest entire amount in this amount, if beta also is 1, then RM will be 9% assume. Okay, market return is 9% assume. Now the equation will be, okay, RF 6%. This is assume 6%, some number here. Okay, 6% plus beta times the RM minus RF, which is 3. This portion, okay, RM minus RF, RM is 9%, RF is 6%, now RM minus RF is 3%. But this you should multiply with beta. Beta times the RM minus RF. I will show you very simple. Yeah. If you invest entire amount in RM, market, security, what happens now? It will earn you RF plus beta is 1 na. Beta is 1 of the RM na. Upper beta 1 I can replace. RM minus RF, this is same. Beta when is 1, this is nothing but RM minus RF na. Upper RF plus RM minus RF. Upper RF gets cancelled. RM is the return you will earn. Upper entire amount if you invest in markets, if your beta is 1, the return which you earn from this portfolio, if your portfolio beta is 1, the return from the portfolio is simply RM. Are you listening what I am trying to say? Now, when the beta changes, proportionately the return changes, plus or minus it will change. This also levered portfolio, beyond this levered portfolio I told na, okay, financial leverage, same thing will be applicable here, whatever applicable, same thing applicable here. Now the important observation, see carefully, here there is 14% and 16%. Can you see this? The beta 2, assume there is a security, okay, which is more risky than the market. More risky than the market. Now it should be more return than market. Now a market return is 9%. Okay, this security is giving me 14%. Are you listening what I am trying to say? Expected return is 14%. Required rate of return is 16%. Assume expected return is 16%. Sorry, expected return is 16% from the security. Required rate of return na SML return. The risk, see, SML return or KE or required rate of return. All these are same, one and same. Why I am stressing na? Institute module, there are few questions which are interchangeably using expected return and required return, which is not correct. Which is not correct. How can expected return a mean return? How can mean return and KE will be same? It will never be same. Are you understanding? Okay, few people are also saying that expected return is the discount rate. Never. Okay, expected return is not the discount rate. Are you all understanding what I am trying to say? See, definition of value of asset is nothing but present value of the future cash flows discounted at required rate of return of the investor and not expected rate of return of the security. Are you all understanding? Okay, risk factor you should consider. This I explained elaborately in bond valuation also. If you have not gone through the revision lectures, I put everything, 7 hours I think put in the comprehensive revision series. You can go through the bond valuation chapter, which I have put under fixed income security. Okay, the name might be new, but it is nothing but bond valuation chapter. There I have covered everything detailedly. Are you listening? So SML return, KE return, required return, everything one and same. Here you see, okay, the expected return X bar is 16% of the security, and this is KE SML return. You calculated RF plus beta into RM minus RF came to 14%. Are you listening? Which means, okay, this security is giving more than what I require, hence this is undervalued. This portion, the entire portion will become undervalued. Are you listening what I am trying to say? This becomes undervalued. Same way, overvalued zone, if you see that, okay, this is overvalued zone. Why? Because assume the security is expected to give only 10% and you require 14%. Okay, your requirement is not fulfilling up the return below this equilibrium return. If the return is ditto this point, okay, the same as KE, it will be fair. It is nothing but fair price. There is no under or overvaluation. See here, notes, everything I have given, go through. For a beta of 2 times, when we invest in levered market portfolio in the sense levered market portfolio itself levered, okay, levered now, which means risky. That is what they mean by levered. We can earn a return of 14%, which is called SML return. But the share of R limited for the same beta is expected to give 16% return. Thus R limited is efficient, even efficient than the market portfolio. Now question arises, sir, you told in the assumptions of market is superior over a long run, market is only efficient. Okay, the efficiency frontier and capital allocation, everything will get replaced by the market. Market is superior, you told. Nothing is superior to market. But now you are saying some security is expected to give 16%, which is more efficient than the 14% market. Are you listening what I am trying to say? Market return is only 9%. Few securities are even efficient than the market. You are saying, these are coming under undervalued zone. So they are even above this, they are over satisfying your requirement. Now, how can you say they are efficient? The underlying assumption itself is wrong. You should not question what they are saying. For some particular period, okay, small period, it might be undervalued or overvalued. I will tell you an example. When the COVID news came, the stock price crashed. Okay, market always, remember, the market is superior. Market is superior than any individual analyst. Why? Because I'll tell you, okay, market can be undervalued or overvalued for a short period, but over a long period of time, it will auto correct. It will correct. The prices will, okay, come into equilibrium. Very simple here. I'll tell you, during COVID, what happened? The Nifty dropped from some 15,000 to nearly 50%. There was a drop in Nifty. It became 7,500 or 7,000. I don't remember exactly, but more than 50% drop. Are you listening? It was so irrational. Why? Because people thought there's no tomorrow, right? COVID came, everyone is going to die. There is no other tomorrow. Like this, everyone will assume and sell the stock price. There will be exuberance in market. Are you understanding? But after some time itself, after 6 months itself, when they understood, okay, that there can be vaccine, okay, it can be prevented, right? Lockdown, if we exercise the lockdown and hygiene, everything can be prevented. Like this, when they start realizing, okay, when the count reduced, slowly market initially came up. Instantly after 6 months, they navigated this problem and market came up. Like that Russia-Ukraine war came. Okay, now also war is happening. Yeah, even today, 26. Okay, it started from 2022 or something. 26 or 3 or 4 years it is happening. Correct? Initially market fell down, but thereafter market recovered. Why I am saying all this now? The undervaluation or overvaluation of the security or the market will happen for a short period of time, but over a long period of time it will not sustain. We discussed earlier that market portfolio is efficient in CML. Is it incorrect? Because you are saying it is inefficient, undervaluation, overvaluation, it should be efficient, always fairly priced. Why this is happening? No, because this R limited share will not be permanently efficient. Currently it is underpriced, hence its demand will increase. When some secondary market it is underpriced, the demand will slowly increase. When the demand increases, the price will also increase. Automatically the undervaluation will be fairly valued. It will be corrected, auto corrected. That's what I'm saying. Okay, its price will increase. This concept is nothing new. In the intermediate, C intermediate FM, you would have studied a concept called as Modigliani-Miller. You remember there is a concept called as Modigliani-Miller, in that, okay, arbitrage will be happening. Primary arbitrage, secondary arbitrage, or capital structure theories. There, okay, they try to tell that the market will auto-correct. Okay, right. We will do some questions regarding CAPM and then we will move on. Okay, assume risk-free interest rate is 9%, the expected return of the market portfolio 18%, beta is this much, find out the expected return on any capital asset. See, I explained capital asset pricing model this much to make you understand the theory as such, because see, the revision lectures are not focusing on question answers. Why? Because I strongly believe, okay, that if you are conceptually strong enough, you will be easily able to crack the question, even if new question comes in the question examination. But if you practice only just questions without knowing the underlying theories or concepts, what will happen now? Even if you practice hundreds of questions, okay, the Jan 26 attempt, what happened? Even if you practice hundreds of questions, easily today's technology is there, ChatGPT, easily I can, okay, say to ChatGPT and coin a new question, I can ask. It will give you numerous new questions. Are you listening? Okay, difficult questions also it can frame. So in today's world, it is like playing, okay, the chess in the advanced mode. Okay, computer, when you play chess against computer and in advanced mode, you will never be easily able to win. Are you listening? Anyway, so this is the question. Beta, 3 betas are given. Find out the expected return on any capital asset. Find the following data relates to two securities A and B. Expected return given, beta factor given. Okay, this second portion. Okay, first portion we will try to independently answer. Then we will come back to second portion. See, very simple. SML return KE, we need to find a KE RF plus beta into RM minus RF. Just replace the formula RF plus beta into RM minus RF. Okay, KE for these three securities we will find out. Next, identification of under or overpricing. Just find out the here. See, you see that. See, my dear friends, here they have given expected return. This is wrong. This is clearly wrong. What they try to, you see, beta is given. Okay, they want you to find KE. KE is not expected return, it is required rate of return. Are you listening? Which means you will skip through this part. Okay, this is required rate of return. You will understand it as required rate of return. Somewhere interchangeably, institute uses this expected return, but it's not expected. This is required rate of return. Technically, it is different. Anyway, identification of underpricing or overpricing, you need to find out. KE you will find out for this security. See, here beta changes, na? Yes, the second part of the security, assume risk-free interest rate is given, expected market portfolio return is given, find out the required rate of return also. Here they are asking a required return. Are you listening? They themselves, in the first part they are asking expected return, second part they are asking required rate of return, but both are one and same, don't get confused. Okay, find out the required return and also comment on the pricing as undervalued or overvalued or otherwise. Okay, now see. They have compared also. They have compared. See, expected return and required rate of return, if they are one and same, which means security is fairly priced every time. Yeah, how there will be under or overvaluation? There will be never under or overvaluation. That's right. Okay, identification of under or overpricing. Second part, you see, KE. First required rate of return you need to find 10 RF plus beta into RM minus RF for this security, A and B. Correct. Now under identification of under overpricing, what you do? SML is there, expected return is there. You will compare and find out the pricing. Are you listening? Which means for security A it is 22% KE. Okay, required to give 22, perfectly priced, fair priced. And B is required rate of return, B's required rate of return is 15.6% and expected return is 17% is underpriced. Are you listening? Beta computation without probability. Okay, I have given 2-3 questions you can simply go through. Okay, this is a period given return of security, market, portfolio. This is RM, return of the security. This is for every year there. How to find out this? I told you na, P1 minus P0 plus D dividend divided by P0. This is how they would have found out. They would have found out and they have given the data themselves. Okay, what is the beta of the security? They are asking beta and characteristic line for security. This characteristic line I will explain in sharp single index model in the upcoming video. Anyway, this okay, I can explain the solution, but then you can only understand after going through the sharp model. No issue. What is the beta of the security X? See, calculation of beta simple. Okay, period return of the security RS, return of the security RS, which we learned now already. Okay, return of the security and X bar, X minus X bar, all these things we learned there. Correct? S minus S bar, X minus X bar, return of the security RX, RM, return of the market. Okay, Rx minus Rx bar, RM minus RF bar. See, we need to find out beta. For finding out beta, we require to find out covariance. They are using, see, contextually you need to understand. They have given the historical data. We need to find beta from data. So here you have covariance divided by sigma m square. This formula you need to find out. You need to find out beta. This formula they are using. You need sigma m for this formula, correct? First thing. Then you need covariance of S and M. Are you all listening what I am trying to say? Covariance of security and market. For finding covariance, you need this one. Product covariance Rx minus Rx bar into product of the deviation. You need this column. You already learned. I am not discussing how to find out covariance. You already know that. Now, a covariance divided by sigma m square we need to find sir, why they have found out sigma s is also required yes, sigma s they require, but for a different reason. They have found out sigma s no, they are skipping sigma s. This is the point. Okay, they have not computed sigma s at all. Why? Because not required. See here, if you see, they have done Rx minus Rx bar, RM minus Rx bar and Rx minus Rx bar into RM minus Rf bar. See, this is column 1, 2, 3, 4, 5. 4 and 5 product multiplication they have done as 6th column, but 7th column RM minus RF bar is there. This square, the deviation square of the market they have done, but there is no deviation square of the security. Why? Because you don't require sigma s. Why they have applied this formula? Are you understanding? If you can also find sigma s and correlation also you need to find out. Are you listening what I am trying to say? Correlation given in the question you need to find out. You need to find out. Appo simple for finding correlation again you need covariance. You need covariance, then you need sigma s, everything you use and then find correlation, then again you apply the beta formula and find out correlation. This is like touching the nose like this. That is why they straight away taken covariance, then sigma m square. This formula is used. Are you listening? Okay, you can go through first step Rx bar they have found out RM bar and RM minus RF bar, then a product of this deviation. Okay, without probability, with probability. So what do you do? Summation of this product divided by n. Summation of this product comes to 357 divided by n. You will find the covariance. Don't think I am rushing. Okay, while discussing covariance and correlation, I have explained in the first part of the video detailedly. See, there is no point in explaining basic concepts, okay, if it is not used in advanced topics. Are you listening? That's why I am saving time and going through. Okay, simple. Next, characteristic line market of security X, characteristic market line beta plus alpha plus beta times the RM bar, which we will learn anyway. Now, see, the characteristic market line is nothing but see, security characteristic line for a security. Assume the security X Rx, return of the security bar, is equal to alpha plus beta times the market RM bar. Why I am using this bar as average return only you should consider. Okay, otherwise if you are not considering this, there is another term, error term will be coming. Okay, EI will be coming into the picture. Now error term and all you don't need to discuss here. That's why you just stick on to this. This is the the regressed line. We call it as regressed line, capital characteristic market line. Okay, using regression analysis you find out. Say now you just replace the formula Rx bar we just found out now here, Rx bar and Rm bar 15 12, correct? So you just replace 15 equated to 15 is equal to alpha plus beta. Beta already we found out as 0.505 into Rm bar 12, correct? If you solve this you will get alpha as 8.94%. Up a characteristic market line, simply alpha plus, okay, alpha you will write it, this is constant, alpha is called as constant, 8.94 plus beta times the, so what you say simply, beta you should write, Rm you will keep it as idle, because it is a variable term. Okay, are you understanding? Rm is the variable term. What is the beta? Beta is also constant now, which means point for a security, beta will be same here, 0.505 into Rm bar, like this you have to write. This is the equation now, variable you will keep as such, and constant you will write, and variable you can change the variable, you will get the line, the slope. Are you listening? Constant will be there and the slope will be there. Okay, line, this is a line na. All these capital allocation line, capital market line, security market line, characteristic market line, all these are line na. Line on a basic thing na. Okay, mx plus c, you have the equation for line na, where okay, one will be constant, okay, the c is constant, and the mx, where you have mx, m na, the variable term. Are you listening? The slope, okay, to find out the slope of the line, and there is a intercept, there will be slope and intercept. Anyway, all these things we will learn in sharp single index model. Next, come to beta computation with probability. When probability is given, how to compute beta? Okay, you already know that, very simple, same column you will find out to find out covariance. Only thing is probability into this whatever number you got. Okay, there you did 35 by 35.67 divided by n. Instead of n, you multiply it with probability. Already discussed, please go through. Okay, this you can find out the x bar, then m bar, then standard deviation of s, m. Here they have computed standard deviation of m also. Why? Okay, because see here they have computed standard deviation of the m also, because they have asked, since specifically asked in the question, they have computed. Only do the computation when it is necessary. You are required to calculate the following now: expected return. This is of the SFL share na x bar, correct? Share or and risk of the share, which means sigma of x. Sigma x they are asking. So risk return they are asking. Same way market index also. Okay, m bar and sigma m they are asking. Are you all understanding? Okay, average and then the variation they are asking. Then they are asking beta. I have given you summary also. That is why they have computed standard deviation of the security. Otherwise they would not have computed. Beta covariance divided by sigma m square. This formula they have applied. Okay, then found out 1.52 times. Summary. Okay, expected return given, risk is given. Expected return of market is given, risk is also given, beta is also given. Please go through the solution. Nothing difficult. Okay. Next question, beta computation and CAPM. The following table gives an analyst expected return on two shares of particular market return. Okay, see this question, I will, this is the same type of question available in institute module. I will discuss the question. See here I have used a different method. This is the past examination question, past exam question. The same data was used in the past examination question. I put it here, but in the institute I see study material, similar question to study material they have put here in examination also. Now I will use study material questions for explaining the solution. Okay, because this number might be different because I don't have the solution here. Here I have not given the solution, but I have taken the study material here. See the same question number 13 study material solution is this. So I'll change the data to study material. I'll match the study material data 7% and 25%. So instead of this market return, see 7%, 25%. This is what given in study material. I'm just replacing it 4% and 40%. Okay, 4%, 40%. All the remaining things will be same. Only thing is numbers. Okay, return percentage is changing. 9 and 18%. 8 instead of 8%, it is 9%. Here 18%. Okay, we have question number 13 like this. Are you understanding? So this we will consider and solve. The second thing. Okay. Now, what are the betas of the two share? What is the expected return on each share if the market return is equally likely to be 6% and 20%, which means probability 0.5 they are assigning. Okay. If the risk-free rate is 7% and the market risk is equally likely to be 5 and 20%, what is the SML? What are the alphas of the two shares? These are all the questions that is given. First we will start with beta. What are the beta of these two shares? Very simple. Beta, here they have changed his 2 years data only given now. So first formula you are using. This is the only place where first formula can be used, because specifically 2 years data only should be given to find out the change in security return. Okay. Return divided by change in market return. This year they used 40% minus 4%, which means two different scenario given na. See, 40% minus 4%. For aggressive stock, change in security return, change how much? 40 from 40 to 4, 36%. Divided by here change 25 minus 7, 18. Okay, 36 divided by 18, beta comes to 2 times. Are you listening? For aggressive stock? Defensive stock like this, it comes to 0.5. 18 minus 9% divided by 25 minus 7. Listening? Now, alternatively, by using this equation, also you can find out, forget about this, no need. This is sufficient, don't get confused. Okay, why? Because we will understand in sharp model that just you can use and you cannot just use this and find out. Okay, there is an issue, I'll discuss later. Okay, this is the best thing. Change in security return, change in market return. Okay, this can be used. This also can be used, but you need to know when to take, the average return or actual return. That I will explain in single index model, no issue. Okay, next expected return of these two stocks. Expected return, average return, yes, probability given, probability weighted return. Up 0.5 into 4% plus 0.5 into 40%. Simple average return for the aggressive stock is 22%, for the defensive stock is 13.5%, no issue. Next, expected return on the market portfolio. There also they have given the probability for the market 0.5 into 7%, 0.5 into 25%, 16% is the average return of the market. This is nothing but RM bar. Are you understanding? This is nothing but aggressive stock bar. Okay, RX bar. This is RY bar. Assume RX and Y are aggressive and defensive stocks. Okay, next, last, here it's a market risk premium. What is the market risk premium? See, very simple. 16% is the expected return from the market portfolio, and market risk premium is, what is that? The difference, see here, see. Yes, market risk premium is what? RM minus RF, na? The RM, they have considered RM, okay, the average rate, na? So, RM bar minus RF, which is nothing but 16 minus 7.5%, 8.5%. Are you understanding? SML is required rate of return. See, here, required rate of return is what? R of 7.5%. One more thing, in the question, in this question, risk-free rate is 7%. That is a change. See, institute has changed the numbers and asked a question, same way. Okay, here, in the study module, it is 7.5%. That's why they have taken 7.5% there. Don't get confused. Okay. So SML return, required rate of return. SML is required return. See, they have themselves they have given SML is required rate of return, and their expected return is something different. See, expected return is this much. Okay, required rate of return is this much. Are you listening? So 7.5 plus beta times the RM minus RF, which means 8.5%. Beta times the market risk premium. Okay, beta also they can replace. Already beta found out, yeah. Already beta 0.505 is there. They should multiply and show the real, but they have not asked, okay, SML return as such. They have just asked simply SML. I am thinking that that's the understanding. See what they are asking. What is the SML they are asking? What is the SML? Security market line. Okay, so while you write the security market line, you should write that, what do you say? See, RF plus beta into RM minus RF. Here, RM minus RF number you will write, RF also you will write. Up 7.5% plus beta into 8.5%. Like this you will write, because they have asked a line like this. That is what the interpretation of the institute, I believe, from the question, from the solution given. Okay, if they ask SML return, or if they ask KE, okay, it is required rate of return, na? Then beta, you should not simply write beta. After finding out beta, you should replace it with that, correct? You should replace and find the exact number, 15%, 16%, some number, you should replace it, correct? Next, what are the alphas of the two shares? Alphas of the two shares, that also you need to find out. Here I have given, see here, alpha, okay, just now I explained in the previous question, na? Okay, see, RM bar, okay, see, security bar, RX bar, okay, assume this is RX bar, this is RY bar. Aggressive stock, this is aggressive stock, this is defensive stock, correct? Now you need to find out alpha, na? Very simple. Here, RX bar, what is the alpha? The formula you will replace, okay, RX bar, we already know that is 22%. Alpha of the average return of the aggressive stock, 22% is equal to, you equate it, alpha plus beta times the RM, na? Alpha, you don't know alpha, simply write alpha, plus beta you already know, of the aggressive stock is 2 into 16%. Okay, RM bar. Here also this average return taken. Are you listening? Importance of this only after sharp index model you will understand. Say, now alpha plus beta times the RM bar, how much you will find out? Alpha is equal to minus 10%. Here also alpha is equal to 5.5%. Are you understanding? But there is a catch in this question, which of course you will understand. See, now I think you are matured enough to understand one thing here. They have asked simply alpha. There are two alphas in our subject. in our portfolio management chapter. One is the Jensen's alpha. The portfolio measure is there, na? The Jensen's alpha is there. Are you all understanding? The Sharpe ratio, Trainer ratio, Jensen's alpha, Morningstar, like this, there are some, measures, ratios which measures the performance of the portfolios, I will explain later. In the mutual fund chapter, I will explain. Okay, I am not putting that portion here in portfolio management because it will get too lengthy. So I will shift the portfolio management. See, mutual fund is nothing but portfolio. It's an extension of portfolio management chapter only. Okay, there I will discuss these portfolio performance strategies. Okay, many people discuss in here. Institute module also given these strategies inside the portfolio management chapter. But we are going to discuss in mutual fund chapter. It's nothing but extension. So I will discuss there. There we will come across a concept called Jensen's alpha. What is this Jensen's alpha? See, the Jensen's alpha is nothing but required rate of return minus expected return. Required rate of return minus actual return or expected. See, very simple. Actual return minus required rate of return. This I call it as Jensen's alpha. Are you listening what I am trying to say? Okay. How much the return is expected to give over and above the required rate of return, whether my required rate of return is satisfying or not. By using this Jensen's alpha only, the required rate of return minus expected return, whether it is over satisfying or under satisfying, undervaluation, overvaluation is a measure to find this. Are you listening what I am trying to say? So, Jensen's alpha can also be used in, technically Jensen's alpha only should be used in this question. Why? Because you have expected return and you have required rate of return. Simply compare this and find out Jensen's alpha. The alpha which I believe in this question contextually should be Jensen's alpha, but Institute has solved using taking SML return. Why I am saying this? Why Jensen's alpha is more relevant? Okay, there is a context to it. There is a reason, because if you read the question, it doesn't look like a Sharpe single index model. Are you understanding what I am trying to say? It's not an isolated. You cannot solve 3 or 4 part of the question using CAPM, and suddenly you come across the alpha and solve the question. Are you listening what I am trying to say? Even though by equating the alpha you get the same beta, but the 4th part I am suspecting that it is actually Jensen's alpha, but anyway suggest answers has given it as assuming this alpha, the intercept alpha of the Sharpe single index model. Anyways you have to see, you have to follow the Institute. Until they come up with some correction. Numerous corrections are to be made in Institute module. This is no joke, in our subject. There are a lot of corrections to be made, to be frank. So Institute also is correcting, slowly they are coming up with corrections, in their module. And I don't know when this will be getting corrected, but this should be, the answer should be Jensen's alpha. They should solve using Jensen's alpha. They have taken Sharpe single index model to solve the alpha. Anyway, this is the situation. I have given you the, segregation. You can solve using alpha, single index model, no issue. Next come to the portfolio beta. Now shall we discuss portfolio beta? Now only 2 things are pending. One is portfolio beta, levered, unlevered, and proxy beta. 2 things are to be discussed. Shall we? So what do you mean by portfolio beta? Portfolio beta is nothing but weighted average beta of the individual securities inside the portfolio. That's it. See, just like your portfolio return, weighted average return of the individual securities inside the portfolio, so same way here also portfolio beta means what? Weighted average beta of the individual securities inside the portfolio. Sir, you told that in this model, CAPM model, beta will take as a measure of risk instead of standard deviation. There, while we compute the standard deviation of the portfolio, we considered 3 factors influencing the standard deviation of the portfolio. One is risk of the security, and the weight of the security, and then the co-movement of securities inside the portfolio. Agreed? Here, when I say portfolio beta is just a weighted average beta of the individual securities inside the portfolio, yes, you consider the risk of beta of individual securities, and then you consider the weight of these securities, but co-movement of these securities is not considered. Are you listening what I am trying to say? So in that case, co-movement, where is this correlation coefficient? Why the correlation is not considered? You should not ask. Why? Because here the correlation coefficient already is considered. For example, I'll tell you here what happens. See here, portfolio beta, you have assumed the portfolio. In the portfolio here, this is portfolio beta. Here you have market, right? What happens here? The security X or Y inside the portfolio is correlated to market. Beta itself captures the correlation. Are you all understanding? The beta itself captures the correlation. For example, okay, what is the beta of X limited? Sigma X by sigma M into correlation of X and M. Are you all understanding? So beta, inside this beta, there is correlation of X and M. Right? Same way, inside the correlation of Y or beta of Y, we have the correlation of Y and market. Are you all understanding? Which means the beta itself contains the correlation. You need not put it separately. That is what they say. But sir, one question may arise here. Okay, the correlation is not between these two securities. The correlation is between one security and the market, the other security and market. Are you all listening? Beta of X captures the correlation between X and M. Beta of Y captures the correlation between Y and M. But okay, there we learned that the correlation should be in within these two securities inside the portfolio. Okay, where is that correlation? Okay, no, we will not consider that correlation. Correlation between these two securities inside the portfolio, okay, is a representation of unsystematic risk. It's unsystematic risk and we will not consider. Are you understanding what I am trying to say? Is totally irrelevant for us, because while computing CAPM, we only consider correlation as per the CAPM. We only consider correlation between the securities in the market, and the correlation between these two securities is irrelevant. Are you listening? The correlation is inside the beta calculation itself. Okay, but the correlation is between market portfolio and security. What happened to the correlation between the securities? Correlation between securities is unsystematic. CAPM measure only systematic risk for determination of KE or market risk premium. Are you listening? Okay, now, so portfolio beta formula here I have given. Okay, this is nothing but weight A into beta A plus weight B into beta B. Shall we solve a question in this regard? Yes. Okay, see, you are analyzing a portfolio consists of 4 securities. Data are security, beta, expected return, amount invested. Okay, this is return, beta. Right. Calculate portfolio return and beta and analyze the individual securities. Assume RM as 10%. In this question, if you notice, RF is not given. RF is not given, but should be understood that the security B, beta is 0 and the expected return is 6%. Are you all understanding? Okay, which means the beta, okay, if you see the return is 6%, I'll show you like this. If you see, beta is nothing, RF plus, K is nothing but RF plus beta into RM minus RF. Agreed? This RM minus RF is market risk premium. This, if you multiply with beta, what will happen? Okay, if the beta is 0, the entire this portion will be 0. Are you listening? Which means the RF where the beta is 0, okay, and the expected return is 6%, it is implied that the RF is 6%. Are you listening? Only when the RF is 6%, okay, when the beta is 0, the entire thing, okay, the expected return of the security will be 6%. It is implied that RF is 6%, even though they have not given. So RF is 6%, you have to solve. Right. See, now first step, portfolio return, weighted average return of the individual securities inside the portfolio. Now, weight is given in the question, not given. What you should consider? The market value weight. You used to compute book value weight, market value weight. In the question, if you notice, there is amount invested, they have given. What do you mean by this amount invested? See, very simple. In our subject, unless otherwise stated, everything will be market value. Everything should be market value and not the book value. Which means originally 1980s, your grandfather bought some house, okay, and you are calculated the return on that investment, okay, you took annual rental income divided by cost, you should not take the 1980s cost. Are you listening what I am trying to say? So you should consider only market value. Current year opening market value you will consider for computing the return. Same way here also, for finding the value proportion weight, okay, we need to use this market value weight. Is implied that is market value, right? Security A, B, C and D, the total comes to 18 million. Out of this, the proportion of A is 3.8 divided by 18. 5.2 divided by 18.289. Like this, you need to consider the market value. Are you understanding? The weight of the securities inside the portfolio, market value weights. Next, return of the portfolio given and weighted return. Weight into return. Okay, you will get weighted return. Total of this weighted return comes to 10.59%. Are you all understanding? Okay, next, portfolio beta computation is also simple. Same, just like return. This column, everything will be same. Beta will be the only change. Beta given, straight away consider that this is beta given and this is weighted beta. Total of weighted beta, okay, is how much? 0.79. So return of the portfolio, K is RF plus beta into RM minus RF. Okay, this if you apply this, you will get the KE as 8.84%. The required rate of return from the portfolio, okay, is 8.84%. If you notice, okay, the security C gives a higher return for lower beta than the portfolio, hence portfolio is inefficient. Here, if you see that the required rate of return from the portfolio is 8.84%, if you carefully notice, okay, the security C is giving me a return of how much? Okay, expected return of 10%. Are you listening? So the security C is giving me a return of 10%, which means it is more than my required rate of return. Okay, as they have given. Anyway, I have also put it. Next, levered and unlevered beta. Okay, very, very important concept. Levered and unlevered beta. See, what happens? I'll give you a background and I'll explain. No need to see all these notes. I'll explain separately. See what is happening. Okay, levered and unlevered beta. To understand this, I'll give you a background. See what happens. The macroeconomic factors which I am selling, systematic factors. The systematic factors, okay, the systematic factors affects the return of the company. Ultimately, the return of the company, which means the return means the, okay, see, always in the long run, the share price will follow the earnings of the company. When the share price is falling, share price is increasing, it will be generally the return will also be increasing, which means the earnings of the company will also be increasing. So systematic factors will ultimately affect the net profit or earnings, whatever, or EPS, net profit, earnings, EPS, everything is same. Per share basis, it is called as EPS. So now, systematic factors affect the EPS, but not directly. What happens, you need to understand. The systematic factors like inflation, GDP, okay, labor data, or interest rate changes, currency fluctuations, all these, okay, pandemic, just like COVID, okay, any systematic factors will affect the sales of the company. Are you all understanding? It will affect the revenue of the company. Thereafter, what happens? Okay, sales of the company is getting affected. Therefore, okay, gradually EBIT of the company will also get affected. Okay, from EBIT, the EPS of the company will get affected. Listening, so systematic factors will affect the sales of the company, through which it will affect the ultimately earnings of the company. But one catch is there. Yes, systematic factors will affect the sales of the company, but not all the companies will get affected, okay, in the same manner from this systematic factors. Are you listening? For example, okay, two companies are there. One company may be too sensitive to interest rate changes, while other company may not be that much sensitive to interest rate changes. Are you understanding? One company might be heavily impacted, other company might be slowly impacted. Okay, for example, if you take during COVID, what happened? Every company, generally the manufacturing company, other company, tech based company, all these companies got impacted generally. But if you notice the okay, pharma company or hospital based company, okay, their revenue did not get impacted. In fact, it increased. Are you listening? So sales of the company will get impacted, but not in the same manner. First point. Second point is, so sales of the company is getting impacted, not the EBIT of the company or EPS of the company will not get impacted, okay, in the same manner. Why? Because there is a in between, okay, say income statement. If you see sales, variable cost, then there is contribution. If you reduce the fixed cost, you will get EBIT, operating profit. There, what they say now, if there is fixed cost in the capital structure, if there is any operating leverage, you already know what is operating leverage. Fixed cost in the cost structure, presence of fixed cost in cost structure is called as operating leverage. Higher the fixed cost, higher the operating leverage. Are you listening? Which means where there is operating leverage, higher operating leverage, sales will get affected. Suppose sales get affected 1x, then the EBIT can also get affected 2x. Yeah, the presence of fixed cost in the cost structure will boost or magnify the impact of the negative impact of the systematic factors in the sales. Okay, are you listening? That will impact, that will increase the impact. Now, this is the impact of the fixed cost. Next, EBIT is getting impacted. From EBIT, EPS is also getting impacted. This can also be magnified due to the okay, fixed cost, or I can say fixed interest or fixed financial cost, fixed financial cost, which is interest or financial cost. Due to this, okay, this is a financial leverage. If there is any financial leverage, okay, this is nothing but presence of debt in the capital structure. If there is debt in the capital structure, I need to pay a lot of interest now. Okay, if there is a lot of interest, what will happen? The EPS will further get reduced if EBIT is getting impacted. Listening, so which means, okay, systematic factors will affect sales will affect EBIT, but subject to, okay, it can also be higher subject to the operating leverage, subject to the operating leverage. Next, EBIT, okay, from EBIT, EPS will get impacted, but if there is financial leverage, it will be magnified, the impact will be magnified. Are you listening? This understood? Now, we have two more things to discuss here. See, I am taking a balance sheet, okay, just for your reference. What happens? Business is all about, okay, raising fund. Here we have equity capital, debt capital, agree, okay, two broad capital, equity and debt, and we invest this capital, we raise the fund, okay, and then we invest the fund in fixed assets, assume current assets like this, assets will be there, okay, we invest this amount in assets, this assets will generate profits, okay, return, this return will be returned back to the capital providers. This is the cycle of the business. Now, the return is there now, okay, the return, so what is the source of this return? You need to understand, okay, the entire portfolio management chapter, two things you need to understand, one is risk, one is return. Now I am trying to make you understand the return side, okay. Now return is the return as well as risk, both has source as well as destination, which means it originates from somewhere and it reaches somewhere else, correct? Very simple. The return, which I call it as profits, the source of this profit is asset is only generating return. Are you listening what I am trying to say? Now, this return will ultimately be shared among whom? The debt holders and equity holders, correct? Upper destination of this profit is where? What is the destination of this profit? Equity capital and debt capital, which is the liability side of the balance sheet. Are you all understanding? Which means the profit goes to debt holders and equity holders. They share the profits. Debt holders take interest from the business, and equity holders balance leftover amount they will share. Are you all listening? This is what happens in case of return. Upper return will be shared among debt holders and equity holders. Fine. Now, just like you have, okay, return, risk also is there, na? So risk also, if you see, the asset only, okay, will be the source of the risk. What is risk? See, variability in return is only risk. Na? Every year the company is, generating 10 lakh profits. There is no variability, there is no uncertainty. 10 lakh is sure short profit, or 10% growth in the profits is sure short. Na? Then what is the variability in return? There is no risk in the business. Are you all understanding? Risk is business is what? Na? The variability of the cash flows or the profits of the company. Which means, you tell me, variability, what is the source of this risk? Source of this risk also is the same place. Are you all understanding? So, asset is only generating return, and the source of the risk is also the asset only, correct? Upper risk is generated by this asset, and the risk is also shared among, okay, equity and debt. Is to be shared among equity and debt. Here only, okay, you need to understand, debt holders, they will take return from the company, but when it comes to risk, they say, I don't want risk, okay, they only need fixed income security. Now that is why fixed income security, which means they will take only fixed return from the security. They will not share the variability. The risk arises from the variability, so they will not share the risk. Debt says, I will not share any risk. Entire equity, risk you should bear. Equity holders are bearing. Are you all understanding? About the company, see, this year it produced a profit, it generated a profit of 20 lakhs. Next year the company, okay, had a loss of 10 lakh rupees. Company says, see, we have a loss of 10 lakh rupees. Current year we cannot pay you interest. Please wait for 2 more years. We are into, into growth. Okay, we are trying to grow, and after 2 years we will pay you interest. Will they agree? Are you all understanding? Will the debt holders agree? Will not agree. So risk will not be shared the equity holders will only share. Now you understood what is happening. So return they are sharing, but risk they are not sharing. Because of this, this company, what is the, okay, this company called as levered company. Levered company, you already know that. What is levered company? Levered company means company in which there is a debt in the capital structure. There is debt in the capital structure, which means in the levered, see, this risk is there now. This I call it as business risk. This I call it as business risk or asset beta. Asset beta. Okay, this is not name, okay, said by me. It is in the standard authors. Okay, they have referred this to as asset beta. Are you all understanding? What do you mean by asset beta? Okay, the total business risk of the business risk of the entity. Are you all listening? Now you have business risk. Debt holders are not sharing. Equity holders are not. Equity holders are only sharing now. Due to this reason, the equity holders risk is there now. This is called as beta levered. This is getting amplified. Are you all understanding what I am trying to say? It gets magnified, which means if debt holders share the risk, the risk will be normal. Okay, but the problem is due to this debt holders not sharing the risk, okay, the equity shareholders risk, okay, will get amplified. Are you all listening? To put it simply, I'll show you like this. See what is happening. We have two betas. One is that beta asset. This is asset beta. I call it as business risk. Are you listening? Total business risk of the company. Then there is beta equity. Equity beta. And there is beta debt. The beta debt is 0 because they will not bear any risk. Are you all understanding? Equity beta I again classify. Equity beta again classify into two. Beta levered, beta unlevered. Are you all understanding? Beta unlevered means both are equity beta only. This you should not get confused. Beta levered means equity beta. Beta unlevered means asset beta, and you should not understand. Are you listening? Beta equity is classified into two: beta levered and beta unlevered. Beta levered and beta unlevered. You heard na? Unlevered. Beta levered means equity beta of a levered company. Are you all understanding? Beta unlevered means equity beta of unlevered company. Are you all listening? What is the difference? Okay, both are equity betas only. Beta, this is equity beta of levered company. This is equity beta of unlevered company. But there is a catch. What is happening? Where there is no leverage in the company, where there is no debt in the company, beta unlevered will be equal to asset beta. Beta unlevered will be equal to asset beta. Why? Because there is no debt in the company itself. Yeah, entire asset business risk will be held by the equity holders. Are you listening? Which means beta unlevered, okay, equity beta of an unlevered company is, how to understand it? Equity beta of the unlevered company will be same as asset beta of the company. Agreed? Now come to beta levered. What happens to beta levered? You tell me. Beta levered, okay, will be greater than beta unlevered. Will be greater than beta asset beta. Beta levered will be greater than asset beta. Sir, what you are saying? Very simple. Beta levered, okay, in case beta levered will be greater than asset beta. I am going to show you an example. No worry. I told you, it get magnified. Total asset risk will be there, business risk. Assume it is 2%. Okay. The equity beta, levered beta will be even more magnified. It will be 4% due to the presence of the financial leverage, due to the presence of the debt in the capital structure. For example, this levered beta. Levered beta will contain business risk. Agreed? And it will also contain financial risk, which is, okay, due to which it is magnified. The business risk is called as asset beta. Financial leverage, okay, due to this impact on the debt in the capital structure, the beta levered will get amplified. Are you listening? All these things I have given notes. Now you will understand clearly. You can go through all this I have given. Okay, you can go through, nothing different. See, source of the risk, destination, reason, okay, and understanding return side of the balance sheet. The same thing I have given as notes, risk of the balance sheet. Okay, see, this only important discussion. Now you will understand. The equity beta can be analyzed further. See, can you see? It is to be understood that the debt takes a fixed return from the business and hence it will not be affected by the variability in return. In other words, the debt do not share the risk and the risk of the entire company is borne by the equity shareholders. Thus, the debt beta is 0. Debt beta is 0. The equity beta can be further classified, and all equity company is called as unlevered company. All equity company is called as unlevered company where there is no leverage. Equity beta of unlevered company is called as beta unlevered, has only business risk, which means asset beta will be equal to unlevered beta. Company which has debt is called as levered company. Equity beta of levered company is called as levered beta. Okay, has both business risk as well as financial risk. Hence, the beta levered will be more than beta, asset beta, beta A. Okay, the relationship between the levered and unlevered can be understood as follows. Unlevered company risk and see, unlevered company risk only, return no issue, risk only is the issue. See what happens, asset beta is there, assume the asset beta is 1.2, assume the asset beta is 1.2. This is to be shared, yes. If it is an unlevered company, what happens? No debt, okay, there is no debt involved. Up an entire equity portion, 100% equity, all equity company, the 1.2 will be borne by the equity holders, no issue. Asset beta equals, okay, unlevered beta, agreed. Now come to levered company, here only there is catch. Now asset beta comes to how much? 1.2. Now asset beta 1.2. Now the weighted average beta, liability beta should also be 1.2. Agreed. But here what happens? Debt holders take no beta, 0 beta. 40% assume the debt is there in the company 40 and equity 60%. Are you all understanding? Debt equity ratio 0.6 is to 0.4 is to 0.6. Assume this is the situation. And what happened? Debt equity, debt beta is 0. Na? Up a weighted beta is also 0. Now the 1.2 should be borne by the equity holders alone, but only 60% of the, which means, see, 100% of the risk should be borne by only 60% of the shareholders or 60% of the stakeholders. Are you listening what I am trying to say? Which means here, okay, 1.2 is the weighted risk. This, the proportion is only 0.6. So how much is the real beta, equity beta? It is getting magnified to 2. Are you all understanding? Okay, the asset beta, if shared by only 60% of the capital providers, it will be magnified to 2. They take higher risk. Now it can be seen that the entire asset risk or business risk in case of levered company is borne by 60% of the fund providers, thereby magnifying their source beta from 1.2 to 2. So what is the relationship? This is important. Everything you discuss, this is just conceptual. Now this is the important point. How to convert levered to unlevered, unlevered to levered. Okay, if there is no tax, if there is tax involved, how to solve? This is a, see, from the examination perspective, if you remember this formula, it is enough. But then if you forget the formula, this will help you. The concept will help you to try to visualize and get the formula. See, very simple. What is beta unlevered? Na? Beta unlevered is equal to, okay, the debt by equity divided by equity. Beta unlevered is equal to beta levered is equal to beta unlevered into debt by equity, where this is when the tax is not given. Okay, fine. This is from beta levered to beta unlevered. If you want to find beta unlevered from beta levered, na, very simple. Beta levered divided by debt plus equity divided by equity, or beta levered into equity by debt plus equity. Are you all understanding? Like this you can find out. No issue. When it comes to tax, when there is tax in the question, when there is tax rate given in the question, simple thing, wherever D comes, na, you do it 1 minus T. You make it post-tax. Wherever there is debt comes into picture, you will make it post-tax. Don't ask me a question that, sir, interest only gives tax shield. Debt, how you can make the post-tax debt? You can make interest into 1 minus T, post-tax cost of debt. But how can you take by making debt post-tax, how will you get post-tax cost of debt? Are you listening? This question, this is a separate discussion to be made. I would have discussed this in capital budgeting, advanced capital budgeting, so I am not discussing here. Okay, now very simple, understand. Just like in interest 1 minus T you will do now, wherever debt is coming into the picture, you add a 1 minus T to it. That is the adjustment you need to do where there is tax rate given. Okay, this is all about this levered and unlevered beta. Shall we solve 1 or 2 questions in this regard and move on? Okay, see, asset beta, 2 companies are identical in all respect except capital structure. One company, AB Limited, has a debt equity ratio of 1:4 and its equity has a beta value of 1.1. The other company, XY Limited, has a beta debt equity ratio of 3:4. Income tax is 30%. Estimate beta value of XY Limited given the above. See, very simple. 2 companies are there, AB Limited and there is XY Limited. Are you all understanding? 2 companies are given. Debt equity ratio given for both these company, right? And what they have given, equity beta, beta levered or equity beta is given for AB Limited is equal to 1.1. Listening, and XY Limited, for computing XY Limited, we have been given debt equity ratio and tax rate is given. Now the point is, sir, debt equity ratio is given, AB Limited equity beta is given. First step in the what do you do? First step, convert the equity beta into asset beta. Convert the equity beta to asset beta. Understanding? Okay, which means you have levered beta, you unlever it. You unlever it using its own debt equity ratio, you unlever it. Correct? Now you have asset beta, na? I will lever it using debt equity ratio of XY Limited. Sir, that is fine, but how can you apply the leverage ratio, which means debt equity ratio of XY Limited to unlevered beta of this? Why how can you apply it? This is a different company, this is a different company. How can you do that? That is why this adjustment is important. The question are saying two companies are identical in all the respects except capital structure, which means debt equity ratio is different between these two companies, but all the other aspects will remain same, which means the business risk, the total asset beta will be same. Hence, what we do, if we unlever this, you will get the asset beta. See, if you unlever, you will get the unlevered beta. The unlevered beta will be same, with respect to these two companies. Are you listening what I am trying to say? So, see, up a first step, you have debt equity ratio of AB Limited 1:4. Unlever it, beta unlever, apply the formula beta levered into equity by debt into 1 minus T plus equity is equal to 0.936. You have, this is what, this is beta unlevered. You got beta unlevered. Now, what you should do, lever it, but using, debt equity ratio of XY Limited, debt equity ratio of XY Limited. So, beta levered of XY Limited, how to compute it? Beta unlevered into, debt plus equity, debt 3:4 you will apply, 3 into debt into 1 minus T plus 4 divided by 4 is equal to 1.1. Are you listening how to find from levered to unlevered? If they have given, everything is same apart from the capital structure, then you use that data to convert that to unlevered. Are you all comfortable? Convert to levered again. Next, equity beta. Vinay company's WACC is 10% and its tax rate is 35%. Vinay company's pre-tax cost of debt is 10% and its debt equity ratio is 1:1. The risk-free rate is 8% and the market risk premium is 7%. Why this is given? Always remember, sometimes they may ask market risk premium, which means RM minus RF. That is not RM. If they give directly RM risk, market risk, market return, then you will understand it as market RM. And one more thing is that wherever they give RF, RM, you should understand that required rate of return is implied. KE they need to, they will either ask you to find out KE or you use KE for finding out something else. Listening up. So what is the beta of the equity company's equity, which means reverse working question, you need to find out beta, but KE you will find out first, then you will find out beta. Are you understanding? Yes. How to find KE? WACC data given. WACC, weighted average, beta, where is that? Yes, WACC is given as 10%, which means just substitute, you will get the balancing number as KE. Are you listening? WACC computation, source, proportion, cost, weighted cost, nothing new, intermediate already would have discussed. The same thing, cost of capital. Debt, proportion 0.5, because 1:1 is the debt equity ratio. Cost, cost of the debt is 6.5. How 6.5? 10% is the cost of debt. This is a pre-tax cost of debt. Tax rate is 3.5%. So post-tax cost of debt is 6.5%. Weighted cost comes to 3.25. Total is 10%. WACC. Weighted cost of debt is 3.5. Hence weighted cost of equity, balancing number 6.75. Now weighted cost of equity is 6.75. Weight is 0.5. What is the real cost of equity? KE 13.5%. 6.75 divided by 0.5. 13.5. Now KE is 13.5. Substitute it. KE is 13.5%. KE is nothing but RF plus beta times the RM minus RF. Beta you don't know. RM minus RF. How much is that? RM minus RF is market risk premium. They are given as 7%. Beta comes to 0.785. Are you all understanding? This is a reverse work computation involved in this regard. Shall we move on? We will move on to the next topic, that is portfolio beta, proxy beta. So, what do you mean by proxy beta? See, understand, not all the companies have beta of its own. Why? Because, see, a company, assume that it is going for IPO. It is not yet listed, going for IPO. In this case also it will not have, beta of its own. Why? Because see, the beta formula, what is the beta's formula? Change in, which means the risk of the security divided by risk of market into correlation of S&M. Now risk of security, how will you analyze? Exposed data you will take and analyze. Are you understanding? Exposed data or ex-ante data. But for that, the company has to be listed for n number of years. Now, when it comes to IPO, first time it is getting listed, how can you see the stock price, variability in stock price? You can never analyze. Are you understanding? Therefore, this is one situation where beta will not be available of its own. Then, if the company enters into unrelated project, if a company enters into, diversifies into unrelated project, assume Tata Limited is there and it is already in TCS, jewelry business and eyewear business, all these businesses are there. Assume it is already in steel business and all. assume it wants to enter into, say, some other business, okay, textile business. Assume it wants to enter into textile business. Now, it will never have its own, the beta. Beta in the sense, the point is, while you compute beta, while you consider beta, if it is a conglomerate company, if the company is conglomerate company, there will be so many segments. Yes. Now, there will be so many unrelated segments also. Due to that, okay, the variability will never be stagnant. Are you listening what I am trying to say? So, which means whenever you are computing beta of a the conglomerate company is there, what will you do? The relevant beta, business beta only you need to consider. For example, if you are a new company which you are trying to enter into, assume you are trying to enter into jewelry business and you want to take Tata Limited, okay, by keeping Titan in mind, you want to take Tata Limited's beta as the representative beta, proxy beta. Can you take? No, because Tata Limited has so many segments. Are you listening? Which means you should remove the unrelated portions asset beta and you should only consider the relevant asset beta. Are you understanding? Business risk, the relevant business risk or related business risk only you need to consider and not the entire business risk of the conglomerates. Are you understanding? So in these situations, you need to take proxy beta. You need to take proxy beta. See here, why you need beta? Very simple. Only if you have beta in hand, you can compute required rate of return KE for computing KE. And why is KE essential? It is for valuing purpose, valuing equity shares. You need KE, na? Okay. Therefore, okay, WACC computation project. Okay, you will compare with WACC. For computing WACC also you need KE, and for valuation purpose also you need KE. Hence, okay, to compute KE, beta is the required data, right? So in these two scenarios, you will consider proxy beta. See, in these two scenarios, the company should use the beta of some other company in the related business. This is important, okay, as its beta for WACC calculation or share valuation. Such a beta is called as proxy beta. Now, only thing to be remembered in this proxy beta, 3 points are there. I will, okay, 3 adjustments are to be made. One by one, I'll tell. Okay, you can apply this in question. We have one beautiful question which will cover all the aspects also, right? So see, first point number A, do not take the beta of the company, consider beta of 2-3 companies as an average. For example, if you want to enter into new steel sector, which means you cannot consider one Tata Steel alone or one company alone which is in that sector and then you take it as representative. Whenever you are taking a representative, always you should consider average, okay, simple average or weighted average, whatever given in the question, which means in this case, assume 3 same type of companies are given, the data given, and you will consider those 3 numbers and then do the divided by 3. You just divide it by 3 and divide it by 3 or divide it by 5 companies data is given and divided by 5. Like that you do simple average and find out the average beta. The point is, one single company's beta you should not consider and come to conclusion that this is the business risk. Are you understanding? Okay, you should take an average, 2-3 companies average you should take. Next point, because it will remove the aberrations or extremes. Okay, it will automatically remove, average will be superior. Now, the company selected for the profit beta may be doing portfolio businesses and hence you should remove the unrelated business asset beta. In such a case, only consider the beta of the related business. You should consider only beta of the related business, and this already I covered. This already I told that unrelated beta, okay, you should remove, leaving the beta of unrelated business. Now, last point, very, very important. Companies may have different capital structures. This only, okay, this is an extension of levered and unlevered beta. Already I discussed, so you can relate it. See what happens. Company will have different capital structure. One company of the equity beta is there. One company's equity beta is there. Okay, yes, related business, and yes, of course, it is also average. See, 2-3 companies are there. 2-3 companies equity beta you got. See, beta levered 1, beta levered 2, beta levered 3. 3 companies equity beta you got it. Fine. And this is also related business beta. You divided by 3. You got the average beta also. Average equity beta. But one more adjustment you need to do. The point is, okay, whatever you do, one more problem is that the companies may have different capital structure, which means the company which you took as proxy, these companies will have their own debt equity ratio. Are you all understanding what I am trying to say? So what you do is that their levered beta will be there, you first unlevered it using their respective debt equity ratio. Then you got unlevered beta, lever it with your own debt equity ratio, which means your own company's debt equity ratio, you use it and convert it again back to levered beta of your requirement. Are you all understanding? Proxy beta you will consider, but that proxy beta will also has to be adjusted with regards to the capital structure, and then that first should be unlevered, then levered it with your debt equity ratio. Are you all understanding? This you have to do. Very, very important. Take question number 36. Okay, with this we will be through with this proxy beta also, and entire CAPM will be over. See, Excellent Limited is a frozen food packaging company and is looking to diversify its activities into the electronic business. The project it is considering has a return of 18%. See, what is this 18%? IRR of the project is 18%. Why it is important? While undertaking the project, okay, the NPV, IRR you studied in capital budgeting, remember? Okay, you will compare this IRR with what? WACC. Okay, if IRR is greater than WACC, you will invest in the project, say. And Excellent Limited is trying to decide whether the project should be accepted or not. To help it decide, it is going to use the CAPM approach. The company has to find a proxy beta for the project and has the following information on 3 companies of the in the electronic business. Are you understanding? So this company is entering into new area. It is trying to diversify. Yeah? Yes. Now it wants to enter into electronic business. It wants to diversify. Now so proxy beta has to be taken, and they have given 3 similar companies which are into electronic businesses. Are you listening? Okay, Superior Limited, equity beta of 1.33, financed by 50% debt and 50% equity. Simple. Equity beta given for Superior Limited, debt equity ratio given. Are you understanding? So no other adjustment is there. Simply unlever this equity beta, you will get the asset beta first. Before averaging out, what you need to average? Okay, 3 asset beta you need to average. But before that, there is a equity beta, this is levered. So because you have the debt equity ratio, you unlever it, convert into unlevered beta. Are you understanding? This will be asset beta, unlevered it, correct? Now the point is, okay, thereafter there is Admirable Limited. Okay, has an equity beta of 1.3. It has just taken a total. Okay, it has just taken on a totally unrelated project accounting of 20% of the company's value, that has an asset beta of 1.4. The company is financed by 40% debt and 60% equity. See, totally unrelated project is there. In the Admirable Limited, what is the adjustment? Unrelated project is of 20% of the company's value, which means 20% of the company's value is related to unrelated business, which means it's related to some other business, and you should remove it. Okay, the asset beta is given as, for this, the asset beta is given as 1.4. Company is financed by 40% debt and 60% equity. Last, Meritorium Limited also equity beta is given and financed by 35% debt and 65% equity. Listening up. Assume that all debt is risk-free and that corporation tax is the rate of 3.5%. Note, not 3.5, it should be 35%. Make a change. It should be 35%. Next, Excellent Limited financed by 30% debt, 70% equity. Finally, this company's equity, you will unlever it, right? And apply your leverage ratio. Are you understanding? Your leverage is 30% debt and 70% equity. That is, return on risk-free securities stands at 10% and the return on the market portfolio is 14%. Should the company accept the project? This is a question that is being asked. Okay, first step in a calculation of unlevered of related business. Okay, related business should be covered. Unlevered beta, it would cover debt equity ratio. You unlever it from levered. Agreed? Related business only you will consider. So Superior Limited, you take debt equity ratio is 1:1. Formula is same. Beta unlevered is equal to beta levered into equity by debt. Are you listening? This is the same. Next, okay, is equal to 1.33 into 1 by 1 into 1 into 65% or 0.65 or 1.65. 1 by 1.65. Are you listening? Is equal to into 1 by 1.33. You will get 0.81 as the unlevered beta of related business of first Superior Limited. Agreed? Next, come to Meritorious Limited. Actually, there is Admirable Limited. I will discuss at the end. Okay, come to Meritorious Limited. Easy adjustments. There is no related business segregation. So easy adjustment. Equity beta 1.05 is there. Unlever it. Okay. See, Meritorious Limited, I unlever it. 35-65 is debt equity ratio. I will unlever. Beta levered into 1 plus. 1 plus debt by equity, which is 1 plus debt by equity 1 plus debt by equity debt plus equity divided by this number. Are you listening? 1 minus C. What this formula can be rewritten? Beta unlevered is equal to, okay, beta levered. This is unlevered. You are going from unlevered to lever. Are you understanding? Which means beta levered divided by 1 plus debt into 1 minus T with tax na divided by equity. How to do it? Very simple. So beta levered is how much? Beta levered given in the question of 0.65, yeah. 1.05. Equity beta is 1.05. Okay. Right. This is multiplied by this number. Okay, this will give you the same number. No issue. 1.05. We will solve it. No issue. Okay. Divided by 1 plus debt into 1 minus T divided by equity. How much is that? 1 plus, okay, debt into 1 minus T. What is the debt? 35%. What is the debt here? 35%, 35%, 0.35, okay, into 1 minus 3, na? 1 minus 3 is simply 0.65. Are you understanding? By equity. What is equity here? What is this? 0.65, right? So total it. First you do the division, 0.35, okay, into 0.65 divided by 0.65, 0.35 plus 1.35, okay, 1.05 divided by 1.35, 0.77 rounded off to 0.78. Are you all understanding? Getting the number? Okay, see, this is rounding off, no issue. Next, we have calculated beta unlevered of Miltolis Limited. But now there is important one more adjustment to be made. We have to calculate. Okay, we left out Admirable Limited, na? Yes, we left out Admirable Limited. Admirable Limited beta is how much? 1.3. Are you all understanding what I am trying to say? This Admirable Limited's beta is 1.3. Okay, the 20% related business after you should adjust after converting into unlevered. This is levered beta, equity beta, levered beta. Now you unlever it using debt equity ratio of 40% and 60%. 40 is to 60 na. See, very simple. You want to convert it na? We will do that. Okay, 40 in, see here. So beta unlevered is equal to beta levered divided by, beta levered is 1.3 if I am not wrong, 1.3, yeah, 1.3 divided by, okay, 1 plus, what is the debt equity ratio? 60, okay, what is the tax rate? That also I need to see. 40 by 60, 40 is to 60 is the debt equity ratio, I think. 40 is to 60, and the tax rate of this company is specifically given. All debt is risk free. The corporation tax rate 35%. Okay, right. So 35%, 65%. So debt is 40%, 0.4 into 0.65, right? Because after tax, na, you should consider. Then this is 0.6. Please take your calculator, do this. Okay, this I have not given in the notes, it is missing, hence I am solving. 0.4 into 0.65 divided by 0.6 plus 1.433, very simple, is equal to 1.3 divided by 1.433, some number here, 1.3 divided by 1.433, 0.9071, I can just round it off to 0.91, 0.91. Are you all understanding? Okay. This is the portfolio, overall portfolio's asset beta. Are you all understanding? This 0.91 is there, na? Yes. Now, this is the overall portfolio's asset beta. Now, what we do? Related business you need to convert, correct? Now, see what is happening. This is weighted beta. We got it as 0.91. Now, what do you do? Calculation of beta unlevered of Admirable Limited's related business. Related business. This 0.91 is the, okay, unlevered beta of the entire company. Are you all understanding? Now I need unlevered beta only with respect to the related business. How I should do? Very simple. Related is proportion 80%, 0.8, unrelated is 0.2. Now, what happened? The total is 0.91, correct? Here, first unrelated business, asset beta they have given. That portion of the, what they have given, unlevered business of the unrelated business they have given as 1.4. Now, this is 1.4. Correct? Now this is 1.4, you apply to the 20% proportion, which means what will be the weighted beta? 0.28. Apo 0.91 is the total weighted average beta of unlevered beta of the company. From that 0.28 relates to the unrelated business, and balance 0.63 will be the weighted average unlevered beta of the a related business, but this is weighted average, but this considers only 0.8 na. Appa, what is the actual beta here of the beta if you consider only of the related business? How much is that? Okay, 0.63 divided by 0.8. What is that? 0.79. Are you all understanding how we got this? Is with respect to related business only. Related business, this is how you need to segregate, okay, and find out. So 0.79 you have, so which means we have 3 companies unrelated beta. Unlevered beta. How much? What is that? First, you have how much? 0.81, and then the first company, Superior Limited. How much it was? 0.81. Yes, Superior Limited 0.81. Okay. Next, plus you have 0.78 plus 0.79 divided by 3. Weighted average beta you need to consider. Na, I told you when 3 or more data is given, you need to consider average. 0.81 plus 0.78 plus 0.79 divided by 3, you will get 0.7933. Are you all understanding? Okay, this is the given calculation of proxy beta. Now you have 3 unlevered beta. Proxy beta is equal to average beta 0.81, 0.78, 0.99 divided by 3. Simple average you took 0.79 times. Are you all understanding? Now we need to convert the proxy beta to levered beta, which means we have unlevered beta, and this unlevered average unlevered beta you need to lever it using your own debt equity ratio, that is 30:70. Of excellent limited debt equity ratio is 30:70. So you apply that. Okay, beta levered is equal to beta unlevered into 0.79 into, okay, this is you apply 1 plus C 0.79 into, okay, 1 plus debt into 1 minus T divided by equity. This is like this. Okay, if you do that you will get 1.01. Are you listening? Okay, next calculation of KE. Now you have beta, equity beta of excellent limited. This can I use for calculating KE? Yes, of course. KE is nothing but beta, RF plus beta into RM minus RF, risk free rate given. Beta, just now we found out equity beta, then we will get KE as 14.04%. Next, what is the next thing we need to do? Find out KO. Okay, WACC we need to find out so that you can compare with IRR and then find out whether the project is viable or not. Correct? The source, proportion, cost, weighted cost. Okay, WACC computation, equity 0.70% and debt 30%. Okay, cost of equity 14.05%. Cost of debt, post-tax cost of debt you should consider. So 10 into 65%, 6.5. Weighted cost is this much. Total of this is 11.78%. So IRR of the project is how much? IRR of the project is 18%, and this cost of capital, overall cost of capital, WACC comes to 11.78%. Okay, therefore, since WACC is greater than, okay, IRR is greater than WACC, IRR greater than WACC, okay, it is advisable to invest in the project, okay. Right. So with this we are through with the concept called as proxy beta. Of course, we are through with this entire CAPM capital asset pricing model. Okay, I hope we have covered the concepts well, and question answers, we have few questions available in the institute module. Okay, there are so many questions for CAPM. If you see, there is a particular this particular question. Okay, they will be giving the gold, limit, silver, okay, all these things, various assets will be given, Government of India bonds, this limited, that limited, like this, so many companies would be given. Okay, this type of question where they will give you RF, RM, or sometimes they will give you data to compute RM and portfolio beta they would ask to compute. These kind of questions, okay, are regularly asked. You should go through from the institute material. That is the only request. Okay, with this I am closing the session for CAPM. Okay, in the next video we will see sharp single index model. Thank you.